Hello! In this video we'll consider the deductibility of losses in general. Section 165A permits a deduction for losses that are sustained during the taxable year. Now there's limitations with respect to those losses under Section 165C. Before we get into that, let's focus on 165A. So with respect to conditions for deductibility, so our conditions, there must be a loss and it must be sustained during the year. Sustained being a timing concern. Now, there must be a loss. In other topics, we're going to discuss property transactions, but for now, understand that a loss, there must be, if you remember back to our gross income discussion, there had to be three components: accession of wealth, clearly realized, and diminished control. With respect to realization, we had to have severance. For severance, that was the triggering event that provided the income. We have the same idea for losses, and usually with respect to a loss, there has to be some type of event, whether it's sale or exchange or some other type of event out there. It could be a conversion, something. So with respect to a sale or exchange, we usually take the amount realized, the AR, minus the adjusted basis, and these concepts will be again discussed in other discussions, and that gives us a gain or loss. So if we have a loss, let's say we have a loss, so the amount realized is less than the adjusted basis, then you have a loss. So the question becomes, okay, you have this triggering event, can you take the loss? Well, it's in the year that it's sustained under the second condition. So who can take the loss? So this deals with the conditions of the actual loss itself. Do you have a loss? So who can take a loss? Well, that's what Section 165C deals with. Section 165C has three categories. Three different categories, three kinds of losses. Now, the first, and this really goes to our general deduction discussion with three different categories. There's business, there's investment losses, and then there's personal losses. So these are the three types of losses. Now, business losses are 165C1, and the general rule is that business losses can be deducted, again, as long as there is that realization event, that severance event, that sale or exchange, or whatever event the code provides that allows that actual triggering event, and it's sustained during the year. Investments, the same rule. Under 165C2, investment losses can be taken. And these can be any types of losses. These can be losses from the business. These can be losses from the actual building burning down. Any type of loss you can think. That's with respect to these items. So with business, I mean, like a business deal, if there's a loss, like a sale on some type of item, this can be through this provision, or it can be again, casualty losses, whatnot. Now, personal losses under 165C3, just like our general theme throughout the deduction provisions, personal loss, the general rule, they cannot be deducted. So if you sell your home and you recognize, or you have a loss, okay, let's say you purchased the home, your house, for $200,000, and 5 years later you sell it for $180,000. That's a $20,000 loss when you sell it, because the amount realized is $180,000. The adjusted basis is what you purchased at, which is $200. So 180 minus 200 is a negative $20,000. So it's a $20,000 loss. And if that's a personal home, you cannot take the loss. If it's an investment home that you're renting out, you can take it under 165C2. So cannot take loss under general rule. Now, I want to note that even though I'm saying for a business and investment, you can take the loss in that case, there might be other limitations that you need to consider in a later discussion. Now, there is one exception for personal losses. There is one exception, and that deals with casualty and theft losses. So you can take personal casualty theft losses. And I'm going to talk about the definition of personal casualty theft in a moment. So casualty and theft losses are allowed. are allowed. So we're about to talk about the specific rules for personal losses, personal casualty losses. One thing I want to mention is that through the Tax Cuts and Jobs Act of 2017, 2018 and on, the same rules apply, but really only personal casualty losses can be taken in two cases. When there's a presidentially declared federal disaster, and these rules apply overall to that, and also if there's any casualty gains, any personal casualty losses based on these rules can offset that. Now, the $100 limit that we're going to talk about, the $100 floor that we're going to talk about, that applies to the presidentially declared federal disaster area as well as the AGI limit. But those do not apply to the casualty gain offset. Basically, the idea is that the Tax Cuts and Jobs Act 2018 on has made it more restrictive in terms of when you can actually take this deduction. You just can't simply take it. You got to have a federal disaster zone, or again, you're just netting the gains. So let's go into this. So what exactly are casualty and theft losses? Casualty and theft losses. So casualty and theft losses have been defined to include fires, storms, shipwrecks, theft, those kind of things. Now, the tax court has held that a casualty results from an external force applied to property that the taxpayer is powerless to prevent. So again, that includes theft. So it's things like a hurricane comes and destroys your house, or a fire, or a tornado, or flood. Those are considered casualty. They must be sudden and unexpected. Sudden and unexpected. And again, taxpayer, so TP for taxpayer, is powerless with respect to the event. So it's not within their control. It's kind of like an act of God, if you will. But the idea is that for theft, that's not an act of God, that's an act of somebody else. So that can't be considered act of God. Now, casualty and theft losses can be business, investment, or personal. If they are personal in nature, then there's more limitations. So I'm going to note that. I'm going to talk about those limitations. If they're personal in nature, there's more limits. So with respect to the personal limits, there's an AGI limitation, and there is a floor that must be subtracted away. And these numbers change, so this is for you to take a look at. So I will tell you that at the time of this video being recorded, that there is with respect to the AGI limitation, there is a 10% AGI limitation that must be subtracted away. So we start by taking, if it's a personal casualty loss, we subtract away any personal casualty gains. So that's insurance. So for casualty and theft losses, we always take away or we net the insurance proceeds. Because a lot of businesses, investment, and personal, you have insurance on your home. You have insurance on your business. We net away the insurance. We net away insurance. You don't get to subtract away a loss if you do get compensated with regard to insurance. So if you own a house, let's say the house is worth $300,000 and it's destroyed in a hurricane and you get a check for $320,000 from the insurance company, you don't have a loss because you purchased it for $300,000, right? And you get a check for $320,000, let's say it's the value at the time it's destroyed. Well, you're not gonna have a loss there. Now, if you purchased a house for $250,000 and you only get $200,000, that is a loss because the amount realized is the amount of proceeds you get, which is $200,000. The adjusted basis is the $250,000 purchase price, so that's a $50,000 loss. Now, casualty and theft losses are recorded when the event occurs for casualty. So the when question, when do you record casualty and theft? When the event occurs for casualty, and casualty being acts of God, out of your control. And for theft, year discovered, not the year it occurs. So it's possible that somebody might steal something from your home, but you might not discover it for years later. Years discovered, it's the year discovered for theft. And that makes sense because when you consider the idea of the event, you had no idea that that actually occurred. So it's almost like if you think about like your dominion and control of the item, you didn't even know it was actually stolen. So you're discovered for theft. By the way, the dominion control, there's no way you can have dominion control over a loss. But I'm just giving that same concept like we talked about from the income side. So going back to our personal limitations, the AGI limitation and floor for personal losses. Now those limitations do not apply to business or investment casualty or theft losses. They only apply to personal. Only personal. So at the time of this video, the AGI limitation is 10%. So we start off by taking personal casualty losses minus personal casualty gains, which are the insurance. So that's why I said net that out. That gives us the excess amount. Then we subtract away, and this year, and again, this is for you to look up either in the code or your textbook, what percentage limitation is. It's a 10% AGI limitation. So you subtract away 10% of AGI next for a personal loss. Then you subtract away a floor amount. Now the floor amount is per limitation. Per event. The floor amount today, at the time of this video, is $100 per event. Not per year, it's $100 per event. So if you have multiple thefts or multiple casualties during the year, it's minus $100 per event. And that floor might change depending on, the year. So it's $100 per event. And then that gives you the amount you can deduct. You can subtract that away. That's the amount you can deduct. Now, I want to talk about the actual amount with respect to what a deduction can be taken. The actual amount, the amount of the loss, this is important. The amount of the loss depends on the activity. So we're going to break it up into two parts. We're going to break it up into gain seeking or profit seeking, which is the business or investment, and personal. So if it's gain seeking, we have to contrast fully or completely destroyed and partially destroyed. If it's completely destroyed, the gain seeking, the amount of the loss will be the adjusted basis. The adjusted basis of the property, not the fair market value. If it's partially destroyed, then I'm just going to say that we use the general rule. Now for personal, whether it's completely or partially destroyed, we always use the general rule. And I'm going to put the general rule over here. Because the general rule is a lesser of rule. And there's a lot of lesser of rules in tax. Let me put a line here. So the general rule for the amount of a loss. Again, there's an exception when you're gain seeking and it's completely destroyed. Then you apply the adjusted basis rule. But if it's partially destroyed, you apply the general rule, right? But if it's personal, which is personal casualty theft loss, it's always a general rule. So the general rule is we take the lesser of two items. We take the lesser of the adjusted basis of the property, or number two, the difference between fair market value before minus fair market value after. And this makes sense for when it's partially worthless, because if it's fully worthless or completely destroyed, then it's going to be zero, right? But if it's partially worthless, you subtract away and it's going to have some value, right? Think about it like a hurricane comes and maybe it destroys the roof of the property, but not the whole property. So you take the lesser of the fair market value before, which obviously is going to be more of dealing with the event, minus the fair market value after, or the adjusted basis. You take the lesser of those two. Now these numbers, the adjusted basis for the completely destroyed rule, or the general rule, adjusted basis, or fair market value before, fair market value after, you always take into account insurance. You always subtract it away. You can never deduct insurance is the idea. So that's how you get the amount of the loss. And again, if it's personal casualty loss, you also have to subtract away the AGI limitation and the floor. Now just a reminder, again, 2018 and onward, through the Tax Cuts and Jobs Act of 2017, the personal casualty loss deduction can only be taken for presidentially declared disasters. And yes, you do apply this 10% AGI and the floor, 10% at the time of the video. You got to check it, and the floor. And then again, it only allowed also if there's offsetting of casualty gains with the losses, but you don't have to worry about the floor and the limit. Those are the only times a personal casualty loss can be taken, no other times with respect to that. Now this video serves to be the general roots to the loss rule. There's plenty of other loss limitations out there, including related party losses, wash losses, capital losses, so losses on actually taking a capital loss. Those are just some of them. There's other loss limitations out there. There's many throughout the entire Internal Revenue Code. So just because you meet the criteria here, right? You meet the conditions, you actually have a loss that's sustained. It's maybe your business or investment, or if you're personal, it's going to be casualty or theft. You can't take a personal loss unless it's casualty or theft. Now, just a reminder, again, 2018 and onward, through the Tax Cuts and Jobs Act of 2017, the personal casualty loss deduction can only be taken for presidentially declared disasters. And yes, you do apply this 10% AGI and the floor, 10% at the time of the video. You got to check it, and the floor. And then again, it only allowed also if there's offsetting of casualty gains with the losses, but you don't have to worry about the floor and the limit. Those are the only times a personal casualty loss can be taken, no other times with respect to that. So we go through the loss analysis, and let's say it's casualty or theft, and you've already subtracted away AGI limitation floor, and you use the amount of the loss rules that we talked about, then it becomes, you have to still look at the loss limitations. There's further loss limitations. So Section 165 in itself is a limitation on losses, because not everybody can just take any loss. But there's other loss limitations to consider. So we'll discuss those in later topics.